Where do you all want to start? This is totally driven by questions that you may have.
I just had a quick question about the Apple sheet that we have.
Uh-huh.
They have a PE ratio of 26.5. I didn't know where they got that from. I did like the price. I didn't know what earnings per share they're taking, basically.
That's a good question. I'm not sure either. Let me see if I can track that down for you. I think the easiest is just to go in and grab it off the Canvas site. And it does look like Canvas is back up and running. I don't know if you guys had problems with it. Looked like they were having some serious server issues just a little while ago. So, okay, yeah, so you're looking at the ratio that they give up here. And so what that's based upon, part of why you may be having difficulty finding that is that my assumption, and we should go, I'm pretty sure this is correct. If we go back to the how to read a value line page, if we look here, and so this is the company's recent stock price divided by the latest 6 months earnings per share plus earnings estimated for the next 6 months. So that's why if you're using trailing 12 months, then that parenthetical should apply. Oops. Sorry, I'm blocking the view. Excuse me. Let me get out of there. All right, there. Now you can see what I'm talking about. So if you're notice up here where it mentions PE ratio is the company's recent stock price divided by the latest 6 months and then the forecast 6 months. And so those may be numbers that they don't actually report down below on the value line page. Let me go back to the Apple one. So we do have, so the actual date of this, it's getting a little old, but June 2020. So the forecast 6 months, I don't know where their date of their financials is, their year-end date, but let's assume that we don't have from June on. We may actually not have May or April or even March as well. But those estimated values are what they're using. Now they do give us a 2021 estimated value, but that's for the entire year. They also give us over here some expected growth rates, annual growth rates of sales, cash flow, earnings. But the only one that you might have a hope of actually getting would be up here in the trailing 12 months. So that should be the most recent 12 months. But there again, even at that, it depends on whether they're using an average annual price or whether they're using the current price, something like that. So fact of the matter is that I'm not surprised you can't calculate it. I'm very happy to hear that you were trying because that's a good thing to do. I'm assuming you probably got reasonably close. Is that true?
Yeah, I mean, it was close, but I just wasn't sure if I was doing it
Yeah.
or not then.
No, I think you're doing it right. It's just that there's so many different variations on how you could do it unless you knew the actual formula and you had their raw data. And given that some of this is estimated and it's only a partial year, you won't be able to get it. But I am very happy to hear you're looking at that sort of thing. That's definitely good. I mean, the short answer is on the exam, you're gonna be given a price. Now you may be given trailing 12 months of earnings, and so it's going to be much simpler in terms of computing a PE. Now, what we'll use this for on the exam is I'll have a series of questions that will relate to this that will match up exactly, not exactly, but what we did on Tuesday and we started on Thursday of last week was the figuring out the DDM, using some of the data off of here to get a PE relative valuation, calculating a sustainable growth rate, that kind of stuff. So I would use that to guide me in terms of what sort of questions you might see that relate to this Apple value line page.
Okay, thank you.
Sure, good question. What else?
I guess while we're already looking at that,
Hmm?
and I don't know, figured why not ask now.
Sure.
Can you run us through kind of like the critical, basically the location of the critical information on these stock sheets?
Yeah, absolutely. Let me download that so that I think I'll be able to write here. I don't know. I think that I might have that page over in a different directory. Here we go. This is a slightly older one, but it'll certainly serve the purpose for looking at what we might be looking for. So you'll definitely be looking for beta. You're going to use that to calculate the K, and more than likely I'll have to give you some sort of, in fact, not more than likely, I'll have to give you some sort of risk-free rate and either a market risk premium, or I could give you the total return on the market, in which case you could calculate the market risk premium, which is simply the total return on the market minus the risk-free rate, and then you would use the beta to finish calculating your K. You would also be looking at, for sure, an average PE. They don't give us a price to cash flow. They don't give us a price to sales. So you can, now, while I might ask price to cash flow or price to sales in a different question in the context of this value line page, I would only be asking you about a PE relative valuation. So, it'd be just like what we were doing in class. There might be 5 years that you take an average, get your average PE. Then you're going to have to calculate a growth rate. One of multiple ways we could do that. One of them is to simply take the average growth of earnings right there, or we could do a geometric average. So you just need the beginning and the ending values, and you could do that for dividends as well. Likewise, and there's your dividends and your earnings. And then the other thing we needed out of this, if we were to calculate growth rate using sustainable growth, we're going to need an ROE, and we're using that return on shareholder equity as our ROE. And then we have earnings, and we need dividends to figure out what our payout ratio is. And of course, 1 minus that is the retention ratio times the ROE. That's your sustainable growth rate. So that pretty much encompasses what we'll be pulling off of here, at least for exam purposes. Is that...
Was that, yeah. What was that one top left right under the ticker?
Oh, beta. Yeah.
Okay, sorry about that.
1.05. Yeah.
Awesome.
Yeah.
Yep, that covered it.
Okay, good. Sure. What else?
Yeah, I also had a question on the application.
Okay.
So for solution 7,
Mm-hmm.
how did you formulate like the numerator? Because I saw you have like 4 plus 360 plus 24, but I wasn't really sure where you got those numbers from.
Okay. Which one is that, Tommy? I'm sorry.
It was application chapter 5 and 6.
All right. Let's see. I need this then. And date. Oh, right here. So it's the one on the indices.
Yep, that's correct.
Okay. All right. So let's. So we've got IBM doing a 4-for-1 stock split here, which means that since this is a price-weighted index, that's going to alter the value of the index if we don't do something to affect that. So it would look like IBM lost 75% of its value, and we don't want that. So the thing that we do is we alter the denominator, we alter the divisor that we're using in there. And so is this where you were asking?
Yeah, I just didn't know where you got the 360 and 24.
Sure. Okay. Let me go back to here. So we were. Let's see. I think the problem said that the stock split occurs after the close of market on day 1 and before the open of the market on day 2. So if we were calculating the value of the index at close of market day 1, we'd be using these prices right here. So the 360 and the 24 are Apple and Microsoft's price. Now the 185 is the price at which IBM closed, but because immediately after the market closed, we said, oh, we're going to issue 3 additional shares of IBM stock to everybody who has a single share. So now we have 4 shares instead of just 1. And so that's where, let me go back to the answer here. So that's where this comes from, this 185 divided by 4. That's to show us, okay, this is, if no values change, if the value of IBM doesn't change, and we're just issuing 3 additional shares, then its price on a per share basis should only be $46.25, right? And then we add back in the Apple and the Microsoft values because those were always in there and those won't change. And then we know that ultimately the value of the index before the split was 189.67, and we want it to stay at that value. So what we're looking for is what is that divisor right here that will leave the value of the index at 189.67, and the answer is 2.268. Remember, we started off with a divisor of 3. We picked 3 just randomly because there are 3 stocks. But now, going forward after the split, we'll always use 2.268 as the new divisor. And does that help, Tommy? Oh, there you are. For some reason, pictures moved around on my screen. Sorry.
Yeah, that helped a lot. Thank you.
Okay, good. What else? Anything on chapters 5 and 6 while I've got the slides open here? Anything else you guys would like to see?
I had a question on problem 1.
Uh-huh. All right.
I just don't understand where the 7 is coming from.
All right. Yeah, this is all good stuff to kind of clarify. All right, and that was just a given. So the 3.75, we're just being given, this is the risk-free rate. The 7% we're being given, and note that 7 is the market risk premium. So when we write the CAPM, the expected return on security I is a function of the risk-free rate plus beta times the expected return on the market minus the risk-free rate. And remember that this term right here is actually the market risk premium right there. So that 7 goes right in here, and it's the whole thing. Our beta, we look it up on the value line page, and then our risk-free rate plugs in here, and we're done. So the short answer to your question is it's simply a given. Now, the longer answer, and this is something you'll get to as we start exploring this security analysis project, is it's not quite that easy. It's pretty tough to come up with what's a good proxy for a forward-going market risk premium, and that becomes a very difficult question. Obviously, we're not going to go down a really esoteric academic exercise on that because the research is still being worked on. But it actually is a little trickier when we're working in the real world. Now, the other thing I could give you instead of the market risk premium, if I were to give you just the return on the market. Now, let's say that was, let's say I gave you 10% for the return on the market. Then to calculate your K here, this is, by the way, just different notation, that's also K, right? So to calculate your K, I would have to figure out first what my market risk premium is, and the market risk premium is equal to 10% minus 3.75 because that's the risk-free. So it would be 6 1/4 in this case, and that 6 1/4 would go into these parentheses. So instead,
Sorry to interrupt. I don't know if this is the case for anybody else.
oh, am I still blocking the? Yeah. Sorry about that. Plus, I just realized that I haven't chroma keyed my background either. Bad style here. How about if I go over here? Oops, and then there we go. Yeah, thanks for noting that. I see the window up here, but it's pretty small, and I'm not always watching that. That's pretty much the two options, though. You'll either get the return on the entire market, in which case you have to calculate, you have to subtract off the risk-free, or I'll just give you the market risk premium, and that means that you don't subtract off the risk-free. So keep keep an eye on those two words. Market risk premium means it's already there, just plug it into the parentheses. And return on the market, then you still have to subtract off that risk-free rate.
Okay, thank you.
Sure. Good stuff. Anything else on these? I mean, it doesn't mean we can always come back to this, but while I'm on these slides, do you see anything else that was bothering you, where you had a question?
Just for clarification on that, the market risk premium equals the market risk minus the risk-free rate. Is that correct?
Almost. Let me just, term-wise, let me clarify. Market risk premium is the return on the market, not so much the risk. I know what you're saying. It's related to the riskiness of the market, but it's actually the return on the market minus the risk-free. And so another way of writing that is MRP is equal to expected return on the market minus the risk-free rate. Yep. And we'll be digging further into CAPM right after the midterm, actually. Tuesday after the midterm, we'll start off. I want to talk about the security analysis project a bit, but shortly after that, the first chapters we get into dig further into this. But for this material, just know that CAPM formula. All right. Any other questions, Zachary? All right. Good, good. What else? Anything on, let's see, application 2, sustainable growth rate, just plug and chug. Really, again, the three types of growth rates that we've been using here: sustainable growth rate, arithmetic growth rate, which is simple average, right? Just add them all up, divide by the number of them. And then geometric growth rate, which is we take the ending the ending value, be it earnings, dividends, cash flows, divided by the beginning value, and then we raise that. Well, let me just go straight to that. Right here, we raise that to the 1 over the number of years. So that's this right here. So here's the beginning value over the ending value, raised to the power 1 over the number of years between those two, and then subtract off 1, and that gives you your geometric growth rate. And that's true whether it's earnings, cash flow, or anything else, dividends.
I have a question on that.
Uh-huh, sure.
We would be told, like, if simply we're using the sustainable geometric or arithmetic growth rate, correct?
Repeat that again.
It wouldn't, like, it doesn't matter. We would be told which one we'd have to compute in order to use it, or does it not matter?
Yeah, most of the time you'd be told. Other times, maybe you're only given enough information to do one or the other. But yeah, for the most part, I think I haven't finished making the exam up. I'm still in that process. But I suspect that most of the time it's just simply going to be, use the sustainable growth rate, or use the arithmetic, or use the geometric.
Thank you.
Sure. Let's see, what else did we do here? 4, 2-stage, of course, is going to be in there. You'll see that, no question about it. That's more or less a plug and chug. Just be really careful on the chugging part. Make sure you break out those fractions. If you have to write down a value, carry it out a number of decimal places so that there's no rounding problems. If you're comfortable just storing interim values in one of the registers, I think that's the better way to do it. That's typically the way I try to do it. And then we looked at relative valuation. And again, the things to keep in mind there, for instance, if we're doing the PE relative valuation, one of two ways to get the average PE that we're going to apply in this. One of them is this way, where we take the PE from prior years of the company that we're trying to value. That is good because that company is very comparable, right? It's a great comparable to itself. It's perfect, unless there are changes over the years. The weakness of it, of course, is that we don't know what the market values earnings at right now. We're looking backwards at this. So the alternative way is to get peer companies that are comparable to the subject company and use the average of those peers. We might get 3 or 4 or 5 peers that are very good, close comparables, and take the average of those. And again, we're going to use some sort of growth rate. And again, typically you'll be given what that is, or you'll be told use the arithmetic or use the geometric. I think that pretty much is it in terms of, be able to calculate the change in the value of an index, whether it's a price weighted or value weighted, be able to make that change to the divisor in the index in the price weighted case. That's pretty much it for applications out of chapters 5 and 6. What else?
I have two quick, just housekeeping questions.
Okay.
So did you say that we will only have problems that will require us to use a calculator? Like, we're not gonna, since it's in lockdown, we won't have to go into Excel?
Right. Yeah. And I know there's a capacity to open up Excel and give that availability to you in the lockdown browser. But historically, my experience has been that it is not universal in terms of it working well for people, depending on the system you're on, if you're on a tablet versus a Mac versus a Windows machine. So I don't want to put anybody at a disadvantage for that reason. So yeah, everything will be calculator.
Okay, awesome, thank you. And then you said we just needed we need the formula sheet and the Apple stock sheet. Was there anything else or just those two?
Correct, just those two.
Okay.
Yep.
Awesome.
So I know that the camera is going to be saying, "Hey, you're looking down." I understand that. I mean, yeah, it's not much we can do about that. I don't think it's very efficient doing calculations up on a screen anyway. Sometimes that's, if you practice using a calculator, it's probably the best way to stay with it during a test. What else? Any other any more questions on the just housekeeping pieces, Kristen, or anyone else?
That answered mine. Thank you.
Okay, great.
We can have scratch paper, right?
Yeah. Yeah. I mean, try to use your formula sheet, but I don't mind a blank sheet of scratch paper as well.
Go ahead, Kevin.
I would say if you could go over a homework question.
Yeah, sure.
It's from chapter 6, number 9.
All right. Hang on just a second. Let me get there. And chapter 6, I think, is right here. Yeah. Okay, so here we've got Hank's Barbecue. Let me jot down a few of these values. So oops. Hank's Barbecue just paid a dividend of $2.05. Dividends are expected to grow at 14.5% for the next 5 years, and then level off to 9.5% indefinitely. So I already know this is going to be a two-stage dividend discount model probably. So 9.5 is G2, G1 is 14.5. If the required rate of return is 12.5%, what is the value of the stock today? So we need P sub 0 or V sub 0. And let's see. Let me grab my formula sheet here. All right, I'm just going to let me make sure I'm not going to be in the way. And so actually the number we're looking for is 92.53. Just jot that down. So let me go back to the PowerPoints where I've got a blank page. All right, so my formula and oops, I need to come on here. Need to raise that to the teeth power. And I know why I had a problem. I started too far over to the right. Ran out of space there. And then I've got the same fraction. And that's cap T over here. And note that, this fraction right here and this fraction are identical. So that's what I'm talking about when if you're doing a calculation, do that fraction and then just store it in a register. And then you can easily pop it up when you need it. And so it's that times, again, D sub 0, but this time we're growing it at the second growth rate, and K minus G sub 2. So then it's just a matter of plugging and chugging. So we're starting off with a dividend of $2.05 times 1.145 all over 0.125 minus 0.145. And obviously that's going to end up giving us a negative value out of this ratio. And then we're going to take 1 minus 1.145 over 1.125. And that's raised to the 5th power. And let's see, am I in the way here? Okay, let me start over here. And then the last part of it, we're going to take the 1.145 over 1.125 raised to the teeth power, raised to the 5th power, and multiply that with, why am I reverting back to the notation? I need numbers. $2.05 times 1.095, which is my G2, divided by 0.125 minus 0.095. And let me just run the numbers here real quick and make sure that key is right. So when I do 1.145 divide by 1.125, I get, so this thing right here is 1.017778. And I'm just going to store that in the first register because I'll use that over and over. Oh, and I also need to raise that to the, that was dumb. Hang on a second, sorry. I need to raise that to the 5th power. And there I end up with a value of 1.092106. Now I'm going to store that in the register. So D0, $2.05 times 1.145, all over 0.125 minus 0.145, and that's going to be 0.125 minus 0.145 is a negative 0.02. Invert that, multiply by 2.05 times 1.145. So, all right, so let me clean off some of this, start filling in some of the numbers here. So I end up with 117.3625 negative for this piece of it. And then multiply that by 1 minus, and I've got that stored. So multiply it by a negative 0.092106. Then I'm going to add 1.092106. That's a 1 times, and then I do the other constant perpetual dividend discount model, and that's 0.125 minus 0.095 is 0.03. I invert that, and I multiply by 2.05, multiply that by 1.095, and I end up with 74.825. 74.825. And then multiply that by 1.09. That gives me, so this is equal to some value plus 81.7168. And I'm going to store that. I end up with 10.809. And I get 92.526. Yeah, there we go. Did that help, Catherine?
Yes, thank you.
Was there a particular spot in there, or?
I think when I did it, I just didn't know which equation to use.
Oh, okay. Yeah, always go. When you see a G2, or they talk about it's going to grow at this rate for 3 years, and then another rate from there on out. That'll trigger you to say, "Yep, I'm doing two-stage dividend discount model." At least in our particular case. I mean, the material in the chapter, there are other models we could apply that to. We could even set up a residual income model to be a two-stage type model, but the material in the chapters don't do that. So, yeah.
Thank you.
Mm-hmm. You're welcome. What else? Anything out of 2 and 3, margin positions, short margin positions in particular, or even just, oh, go ahead.
I was just gonna ask, if your initial margin is higher to like 70%, does that mean you have less purchasing power?
Yes. Well, it means you have more of your own money in the position, less leverage.
So if you had the
Yeah.
same net worth and you looked at a 30% margin versus a 70%, you'd have more purchasing power than 30.
Correct. However, recognize that the Federal Reserve Bank will never allow us to go below 50% for an initial margin. Now, the maintenance margin can be lower, and often is, but that initial margin is always going to be 50 or higher. Um, think about that formula. It's equity over value of the position. So it gives us the percent of the position that is our own, right, at any given point in time. Yep. But yeah, make sure you've got that concept down. Let's see, Patrick. Hang on, let me run over to the chat. I only see a portion of it. I was wondering what percentage of the test is conceptual versus calculation based. Not having finished making it, it's somewhere in the 50-ish, 50-50 range, but actually I would say it's more like 60-ish to 40 conceptual definitional versus calculation. Somewhere in that realm. And again, I'm going to give you plenty of material, so don't be surprised that you don't get done. And I would make sure that I got all the matching done, because it's pretty hard to guess on the matching. You've got a pretty bad chance of getting it right, because I'm going to give you a whole bunch of terms. But, if push comes to shove, multiple choice are pretty easy to guess on, various strategies. You can look them up. You can Google various strategies on that. I don't know that they would apply in the case, because I know what those strategies are too. So sometimes people will say, yeah, I'll always pick D because it often is all of the above or none of the above, but that doesn't always apply.
Since there's no formulas for chapters 19 and 20, are those going to be conceptual only?
Yeah, for the most part. Now, I mean, and that formula sheet is really about the numbered formulas out of the chapters, and there were no numbered formulas per se out of those chapters. Now, understanding how to read through a balance sheet or an income statement is going to be helpful. Do you have to memorize it verbatim? No, not necessarily. But yeah, understanding the material that they talk about there. What is the operating expense, or what is the operating ratio, gross expense ratios, that sort, or gross margin, operating margin, that sort of thing is going to be important to understand. But yeah, so there still could be some numerical type questions out of those chapters, and I would look back to the homework as a guide. In fact, I have a list in front of me that are the homework problems, and when I select problems out of the test bank or make up my own, I use that little key to make sure, oh yeah, okay, you guys had a homework problem on this, fair game in my book. It doesn't mean that other questions that weren't on the homework aren't fair game as well, but I'm going to focus the bulk of the questions on stuff that you've had multiple times or stuff that we've covered in class. I'm not out there to throw many curveballs at you. There might be one or two, but par for the course. Does that help, Christopher?
Yeah, thanks.
Mm-hmm. Where else can we go? Any other homework questions? Any concepts that need clarification? All of those terms in, like chapter 5, make sure that you know the difference between two relatively close terms or two competing terms. And if you've got any doubts about those, let me know. primary market versus secondary market, primary shares versus secondary shares, primary offering versus secondary offering. It's that kind of stuff that gets tricky, but spend time on making sure you know that difference.
Kind of talking about the two similar terms. I know we had like two different types of investing. One of them was like asset allocation, and there was a different term that went with it. Could you
Right.
research those?
Sure. Yeah, good point. Asset allocation and security selection, I think, is what you're after, right? Yeah, so those are both. We think of those as active investment strategies. A passive strategy, and let me compare that to a passive strategy, which is I just buy the market in the same proportion, value-weighted proportion as the market is. That's totally passive, and it's a buy and hold. Active means that I'm going to have something other than the market, and that might be for one of multiple reasons. One is that maybe I have some sort of other position that causes me to be undiversified in or heavily weighted in one area. I like to use the example, suppose you live in a relatively small town, you own a house in that small town, and there's one plant that kind of drives the economic engine of that small town. The town I lived in, two plants really did that. So not only do I have real estate tied up in there, I probably work for one of those plants, and I probably have a retirement account at one of those plants. And so I don't want much more exposure to that industry. So there I could do some sort of asset allocation and underweight that industry in my portfolio. And that means that I'll be overweighting other industries and sectors. So asset allocation is all about picking the weighting scheme, something that's different than what the market is. Now, other people might actually engage in an active asset allocation strategy because they think they're betting that a particular industry, sub-industry, sector, even country is going to outperform others over the next period of time. So there you might want to overweight tech, underweight transportation, underweight industrials, that sort of idea. So that's asset allocation. And the key thing is the assets are these broad categories of securities, like stocks, like bonds, like cash, like currency, commodities. You can even get down to kind of a subset. So within stocks, you might even divide those into growth stocks versus value stocks, or high dividend yielding stocks versus low dividend yielding stocks. You can do various cuts of it, but they're kind of these broader categories. Security selection is a complementary strategy. So within whatever category you have created in the asset classes, one strategy is to simply buy all the firms in there based upon the proportion of their market value to the total market value in that group of securities. That would be kind of a passive strategy on security selection, maybe active on asset allocation. Another way to do that is to say, I'm going to pick out particular securities within that asset class that I think are going to outperform. I'm going to buy those. I might even do a long short strategy if I were a hedge fund. So I buy those that I think are going to outperform, and I would actually short those that I think are going to underperform, and I would make money on both sides of it. So security selection is all about picking specific securities within that group of assets. Asset allocation is either under or overweight a particular asset class. And I think that's pretty much the gist of all of that. Does that help? All right, very good. I'll be checking my email fairly frequently up till thereabouts midnight or so. I've got to finish putting the exam together, so I suspect it's going to take at least that long. So feel free to email me, and I will try to, if I can't answer it easily, I might even throw together a quick video or something and use the board here if that's helpful. But one way or the other, I'll try to answer questions up to at least that time. I prefer, mainly for your benefit, it might not seem that way, but questions right before an exam I've found to be very unhelpful. So try to get the questions to me before the exam. I mean, if it's a housekeeping type of thing, feel free, right on the day of the exam in the morning. But I found that if it's, an hour before the exam, more often than not, it ends up confusing folks more than it helps clarify. So try to get me your questions before midnight. If there's an absolute desperate one that you just puzzled on, I'll try, but keep in mind that it may not be terribly helpful on the day of or the hour before. But I'll keep watching my email, and otherwise, if you all have nothing else, I wish you good luck. And by the way, if anything should happen connection-wise or computer-wise as you're in the middle of the exam, let's see. I don't know that my cell phone is posted on the syllabus. I'll just send that out. I'm going to do a brief announcement before shortly after the session is done, just reminding people to print out the formula sheet and the Apple value line page, and I'll plug my phone number in there. So if something goes awry, either call me or text me. All right. So that way we can try to solve it as quickly as possible. Don't hesitate, please, because I'd rather know about it in advance and try to work it out, so that you don't have any technical problems that are going to cause grade issues. All right. Very good. Well, I won't see you on Thursday, but best of luck, and we'll talk to you possibly via email if you have any questions tonight. Bye-bye.
Thank you.
Thank
Thank
you very much.
you.
You're welcome.